Welcome to Incorporate or Not. Today we are taking a serious business decision and turning it into a story because tax planning does not have to feel like watching paint dry.
Our story starts with two partners, Anna and Albina. We started simple, a few clients, a laptop, coffee and one very brave spreadsheet.
But then the practice grows. More clients call, more paperwork arrives, and suddenly the question becomes, should we stay as partners or should we incorporate?
By the end of this video, we will make a clear decision and explain why. Here is a situation. Anna and Albina accounting started as a simple partnership. At first it was manageable. We knew every client, every deadline and almost every receipt personally. Now more clients are calling. We may need to hire help, rent a bigger office and sign a larger contract. That is exciting, but it also brings risk. So we ask ourselves the same question we might ask for a client. Are we ready to incorporate or are we just excited by the word corporation because it sounds fancy on a sign?
Before incorporating, the first question is not how fast can we register? The first question is what problem are we trying to solve? A corporation is not a magic tax wand. It will not simply wave over the business and make all taxes disappear. If only it did, accountants would sell wands at Staples. The real questions are practical. First, do we need risk protection? Second, can we leave profit inside the business for tax deferral? Third, do growth, clients, banks, or investors require a more formal structure? If the answer is yes to several of those, incorporation becomes a more serious decision.
To decide whether incorporate or not, we first need to understand the three main business structures in Canada. So, proprietorship, partnership and corporation. So, proprietorship is a simple outfit. One person owns the business. It is inexpensive and easy to start, but the owner and business are basically connected. If the business has debts or legal problems, the owner's personal assets may be exposed. A partnership is two or more people sharing profit, losses, resources, and usually risk. A corporation is the formal outfit. It becomes a separate legal person with shares, records, and its own tax return. It looks professional, but it also asks for paperwork, lots of paperwork.
Here is the simplest comparison. Sole proprietorship is easy, but personal liability is a big risk. Partnership brings shared resources, but also shared responsibility. A corporation creates separation. The business is no longer just us. It becomes its own legal person. That separation is powerful, but it is not free. It comes with corporation tax filings, records, minute books, and more professional fees. So, the decision is not about which structure sounds best. It's about which structure fits the business stage.
Partnership have a plot twist. In a general partnership, partners can be responsible for the partnership debts and liabilities. In simple words, the business backpack can be heavy and everybody may have to carry it. A limited partnership has at least one general partner and limited partners. Limited partners usually risk only the amount they invested. But there is a warning. If a limited partner becomes too involved in the management, they may lose their protection. So do not call yourself limited and then act like the CEO every morning. For our case, we are active partners. That means risk and responsibility matter in our decision.
Now let's meet the corporation, the legal baby of the business world. It can own assets, sign contracts, pay tax, issue shares and continue even if the owners retire, sell or die. This is why limited liability can work. Usually, creditors or lawsuits deal with the corporation, not the owner personally. But the separation must be real. The corporation needs its own bank account, records, and proper documents. If personal and business money are mixed, the corporation baby starts crying. Where is my minute book? Where is my bank account?
So, why do entrepreneurs incorporate? First, limited liability. It can protect personal assets, although is not absolute. Personal guarantees, unpaid payroll deduction, or misconduct can still create personal exposure. Second, credibility and funding. Some clients, banks, landlords, or investors take an incorporate business more seriously. It can feel like the business put on a blazer and finally join linking. Third, tax deferral. If the business earns more than the owners need personally, some profit can stay inside the corporation and be reinvested at corporate tax rates. Fourth, exit planning. If shares qualify under the rules, selling shares may allow planning opportunities, including the lifetime capital gains exemption, but these rules are very strict. So this is very professional advice is important.
Now the less glamorous side. Incorporation too early can be expensive. Corporate tax returns, minute books, resolutions, legal fees, accounting fees, payroll accounts, T5 slips. The paperwork does not arrive politely. It moves in with luggage. Also, losses matter. If a corporation has losses, they usually stay inside the corporation. A sole proprietor may be able to use business losses against other personal income depending on the facts. So, if the business is small, low risk, and the owner needs all cash personally, incorporation may not help yet. That is why our rule is simple. Incorporate for a business reason, not because everyone on YouTube said so. The yes usually appears when the business outgrows the owner's pocket. If liability risk is higher, incorporation becomes more attractive. If profits are healthy and can stay inside the corporation, tax deferral may help. If the business will hire employees, add shareholders, raise funds, or sell later, a corporation may be the right structure. And sometimes credibility matters. Some clients simply prefer to deal with an incorporated supplier. But if the business is still a simple side business, low risk, expecting early losses, and all cash is needed personally, waiting may be smarter.
Once incorporated, owners cannot simply grab money from the business like a sole proprietor. The corporation is separate. It needs a proper way to pay the owners, salary, dividends, or a combination. Salary is like a regular paycheck. It's deductible to the corporation. It creates a RRSP room. It contributes to CPP, and banks often like it because it looks stable when applying for financing. The downside is payroll administration, remittance, source deduction, T4 slips, and deadlines. In other words, salary brings retirement planning and paperwork with a calendar. Dividends are simple to transfer, are not subject to CPP. The shareholders also receive the dividends tax credit, but dividends are not deductible to the corporation and can create personal tax bill if the owner doesn't save for tax. Our advisor answer is there is no one perfect method. The best mix depends on lifestyle cash needs, RRSP and CPP goals, mortgage plan, and company profit.
Another decision is federal versus provincial incorporation. Federal incorporation can give broader name protection across Canada, but the corporation may still need extra provincial registration where it operates. Provincial incorporation may be simpler if the business mainly operates in one province. So, the decision depends on where the business operates, name protection, paperwork, and cost. Then we have CCPC, Canadian Controlled Private Corporation. Small words but big consequences. CCPC status matters for a small business's tax planning, including the small businesses deduction, dividend planning, and qualified small business corporation share planning. For a real client, those rules should always be checked for the current year and province.
If Anna and I incorporate, the work is not finished. it actually begins. First, we open a separate business bank account. Separate money support the idea that the corporation is truly separate. Second, shareholders pay for their shares and we maintain the minor book. Third, we register the right CRA account and decide about GST, HST registration based on the rules. Fourth, we set up bookkeeping and records from day one. And finally, we must file annual returns, resolutions, and corporate tax returns. In short, do not ghost the corporation. It will not tax you, but the deadlines will still arrive. Now we run our final advisor checklist. Profit. The practice is earn more than the owners need personally, so some income can stay in the business. That is met. Risk. Client work, contracts, and possible liability exposure and increasing. Met. Grow. More clients, possible staff, and larger office. That's met. Exit. Shares could become valuable later if the business grow. Met. Administration. Because we are accountant, we can handle bookkeeping, deadlines, and compliance system. Met. And if we cannot, honestly, we should change our business name. Timing. This is not just ego or a fancy sign. There is real business reason. Met. Conclusion. Incorporation is not automatically better. It's better when the business is ready. For our case, the checklist says ready. So our final decision is incorporate.
Not because corporations sound fancy on the door, not because the logo looks expensive, and definitely not because paperwork needed a new hobby.
We would incorporate because the business case is ready. Grow, risk, credibility, tax deferral, and administration all support the decision.
Thank you for watching. Before you incorporate, ask whether you need a corporation or just a better spreadsheet and a good accountant.
And for real tax or legal decision, always consult a qualified professional. Thank you, and please subscribe to our channel and leave comment. This was Anna and Albina. Bye.
Bye.